Welcome to another episode of Corporate CPR, where we breathe life back into your organization, projects, and processes, giving you insights to recovery and avoiding corporate mortality events. Today, we'll be talking about how not scaling your ARR might be killing your company. And joining us to contribute to the conversation is Anjali Mullins. Welcome, Anjali.
Thank you for having me. Nice to be here.
Yeah, so glad you could join us. I'd love for you to share a little bit about your background with the audience, if you could.
Sure. So I'm Anjali. I'm actually sitting in Berlin, originally from California. Started in finance, scaling up sales teams, then moved into the scale-up environment, doing everything from Series A to C across all commercial divisions and many different markets. So I've scaled up companies in the United States and Australia and now in Germany. And I also do board member and advisory work. So very well versed on the topic and really excited to talk to you today.
Excellent. So yeah, well, let's talk a little bit about ARR. Obviously, we hear that more and more with SaaS companies, a lot of our technology moving to SaaS arrangements. But can you talk a little bit about, just to make sure we level set, what ARR is, maybe what it's not, because I know some people try to call things ARR that they really aren't. Maybe we could start there.
Sure. ARR, annual recurring revenue. It's really, in my perception of SaaS, the lifeblood of the business. That can be broken down to MRR as well. But when you look at ARR overall, it's how much are you scaling? How much are clients basically recurring and coming back? What are the products and services that they're using in order to get that to happen? But it really is an estimation of how you're scaling and growing.
Great. And so what is the value of that to an organization?
The value of sales is pretty much everything. It is the lifeblood. If you're not selling, whether it's new business or expansion, it's pretty hard to go anywhere. Hence the headline of this particular podcast. So I would say absolutely the lifeblood.
But I guess, ARR in my, what's the value of ARR versus other revenue? For me, I'm thinking about economic downturns and things like that. So do you see that, more value in ARR, and if so, why?
ARR is always valuable. Especially in economic downturns, this is exactly the kind of revenue that you want. In economic downturns, you usually don't see expansion. So that's kind of where I would separate those things: net new business, ARR, and then expansion. So especially in an economic downturn, you'd have to have consistently new cohorts of new business coming in.
And so, how do you recommend an organization look at their offerings and, figure out what percentage of ARR their revenue should be? How does it fit in with their other products or services? Do you have insights there?
I'm a fan of breaking things down into cohorts. So look at the different cohorts of your clients. What exactly are they buying? What's the reasons to buy? Are they buying only a single product, or is it just one feature via multi-feature? So, depending on the listeners, who are going to be listening to this, advice, if you have one product, try to figure out how to expand the featuring, try to figure out how to expand the value proposition. How do you keep those clients engaged? Because you need not just new business expansion. If your product is a multi-feature set, really start to look at how you can get them involved in the entire ecosystem, the entire portfolio.
And I guess as you have a product you're trying to, product, service, whatever, an offering that is ARR, what's the curve like with that? I would assume that there's a point where it's really hard to get people signed up, and then maybe there's a tipping point. But is there any data or research around how getting people, onto your product or service, how that works?
It really depends on the product or service, but in the normal SaaS environments, usually you have something which is a 30-day free trial. You bring somebody in for a free trial, and then you have that conversion from free trial to paid. I would say it's a little bit harder if a client has to sign a 12-month, / 1-year contract up front. So those are, I would say, are the traditional ones. If you want to take a step back and kind of look on a macro view, it's much easier for scale-ups to constantly, reposition themselves, the value proposition, the pricing, the feature, the offering. It's actually much harder to get net new cohorts once you are a larger company. We tend to see a lot more plateaus, and it's harder to constantly grasp new market share. So for any of the listeners that are in big enterprise corporations, that's where it actually becomes a lot more difficult. If you are in a smaller scale up, it's easier to pivot. If one tactic or methodology or strategy doesn't work, you can pivot to another, and it's a lot more of net new business. If you are selling to enterprises, you're going to have at the beginning of the curve a lot of net new ARR, but then at the end of the curve, you're going to have actually a lot of more expansion ARR coming in.
And are you seeing new ways of people being creative with how to get ARR? I mean, beyond just, oh, here's a license for a product, or, using, an app or things like that. I mean, have people gotten creative in what they're offering and putting in an ARR model?
They've actually gotten creative in how they acquire clients. So instead of just going to market and saying, this is our offer, this is our feature, buy it, they're actually going to their current cohort of clients, and they're starting to do referral programs and affiliate programs, and they're trying to make those streams happen. It's more easy, it's more efficient. You already have a baked in testimonial and referral. So it's more of the tactics that I see changing.
And do you have recommendations on a process on how to be successful, with your ARR offering? Are there certain key things people should be doing to make sure they go to market with something successful?
Yes, I mean, the very first thing is kind of the KYC, so know your customer. And this is something that, even though it's tried and true in conventional wisdom, it is that way for a reason. There's a lot of companies that go to market and they really don't understand their client. They don't understand how their offering fits into the current market setup. Does it provide value? Is there actually an opportunity there? Do clients actually have the capacity to buy? So I'm sure in a lot of the discussions, you've heard the difference between a nice to have product and a must have product. Really taking the time to understand where your product and or features lie within that matrix.
And so do you say that a lot of people don't do well at knowing their customer? So, I mean, have you seen some great techniques that you could share that could help people be more effective at that?
It's really interesting because the best technique, which is tried and true, is just to ask them. And it's amazing how many companies don't just ask their current clients. If you're a listener and you have a cohort of current clients, just take 20% of them aside, ask them, give them either a free product, free services, etc., in exchange for asking them, but just do basic usability studies. That part of it hasn't really changed, but it's amazing how companies still don't take advantage of that. If you are going new into the market and you don't have a current cohort of clients, start asking prospective clients, hey, we're really looking at testing out this new feature, this new product, give them an incentive. We'd really love your feedback, make them a part of the journey and a part of the story. People always like to give their feedback if you ask them. And that's the one thing about ARR growth and sales that's always true. So a lot of companies just need to take advantage of that.
Do you find issues with how companies interpret that data and maybe coming to the wrong conclusions about their product or about the market?
They can if they have confirmation bias. So if they're already too far down the road and have so much investment, whether it's capital, people, etc., into a particular strategy or into a particular product, sometimes they want to use that confirmation bias to basically confirm their own choices. But if those choices aren't really working for them, then they really need to look at the data for what it is. So I do see companies, I think, the saying around statistics, you can make a statistic, support or negate anything you want. So it's really about being open and objective about the data that's coming in. So, it's all in the hands of the people that are managing this particular analysis, but do the analysis and really look at the data objectively.
When you talk about maybe the value, then that, well, I guess before we go there, is there frameworks or tried and true ways of launching your ARR offering and, how to get that best received within the market?
There's tons of frameworks as far as sales is concerned. It really depends on the kind of, business that you're running. But if you're doing outbound sales, there's tons of methodologies and frameworks. So prospecting, BANT, SPICed, MEDIC, SPIN, all kinds of things about qualifying your prospects, about taking them through the sales process, about closing deals. So all kinds of different frameworks. It really depends though on what works best for the client and for your sales reps. So this is something where it's not a one for all type of situation. I would love to say that it is. It'd make me a very rich woman. We'll write a book about it, but unfortunately, it really is more about the product, the services. It's very different if you have an off-the-shelf product that you can buy online with a click of a button and everything is mapped out and you can take them through a 30-day free trial and just convert them into a paid offering versus you have a 6 to 12-month sales cycle and you're selling something that's extremely complex and you need a solutions engineer involved and the technicalities have to be explained and you need 5 departments to sign off on it for, a very large ACV. So these are fundamentally 2 very different, scenarios that have different frameworks and methodologies.
I guess, you just mentioned all the governance, and a lot of times governance there, is put there for profitability. Do you have comments around the strategy around ARR pricing and how to kind of find what the right fit is to the market? Because I have heard of instances where it's actually been priced so low that organizations have been surprised that they're losing money and didn't really think they would be.
It's a really good question. When it comes to pricing, it's always about perceived value. You can price your product or your service for $1 or €1 or for $1 million or for, €1 million. It's the value that the person on the other end who's buying it perceives from that. The conventional wisdom is usually the higher the price, the higher the supposed, perceived value. There's a middle ground there. You price too low, and sometimes, your customer might think, hey, this doesn't really hold that value. I can get it anywhere. So that's why we actually advise companies don't necessarily go to market with price. Go to market with value. What are you offering? Sometimes clients might be willing to pay much more if they perceive that value to be there.
Well, and then I guess the natural next question is, how do you get that message about your value across?
Going back to the know your customer, going back to the talking to customers and doing that proper research beforehand. So, in an e-commerce environment, it's more about iterative testing, especially if you have traffic to the website and you're checking out through the website. In a B2B SaaS environment, it's more about sitting down with your clients, especially if you have a very complex product and you have a longer sales cycle with a higher ACV. You really want to sit down with your clients and understand their pain points, who is involved in the decision-making process, what their perceived value is, and what that's worth to them. So, for example, if you have a service, the value perception is quite high, and you can prove that they're going to save a huge amount of money, they're going to be more willing to pay more for your product or service to get it.
And then I guess, when we're talking about ARR, and what do you find, I guess, the value when you're looking from a company valuation perspective?
It's an interesting question because some years back, it used to be just about ARR. It's no longer about that. When you look at the actual metrics, whether you're looking to raise capital or whichever situation you're in, they're looking at revenue per employee. This is the new metric. They're, of course, looking at your margins. They're looking at LTV to CAC, your CAC payback. There's a lot of different metrics, especially in the SaaS environment, that they're looking at. So it's not just an ARR. And when you look at things like multiples or the valuation, let's be honest, a lot of companies have had sky high valuations, and those valuations can fall just as fast as they rose. So it really is about, the core revenue and then the granular KPIs beneath that. What's contributing to that core revenue? And is it revenue with no strength underneath it? So is there no net revenue retention? Is there no expansion happening? Are you churning clients as fast as you're gaining them? So I think you have to go down a few levels to really make sure, what are you actually looking at?
Interesting. it does. So do you then think it does still influence investor confidence and funding if you are going through the different series?
It really does. If you have strong KPIs and you have a strong story to tell, and you can back up that story with strong KPIs, it does influence investors. And of course, the valuation will go up based off of the strength of those KPIs. But I think the point I'm trying to make is there's a difference in today's economy. Everything is much more conservative with stable and predictable revenue versus 3 to 4 years ago, where everything was about hypergrowth. And investors were, of course, they have to raise their own funds, right, in their portfolios. And because of that, valuations of companies were going through the roof. You're seeing now a lot of down rounds, and you're seeing a lot of consolidation happening. Same companies, right, that years ago had sky high valuations are now doing down rounds.
So what are some of the key metrics then and KPIs that people are looking at today to look at ARR and the health of the company in that space?
In the scale-up environment, I can say that the biggest metric and the hottest one right now is revenue per employee, revenue per FTE, because they really want to see a balanced situation within the company. This is literally, it used to just be, for example, just straight revenue. It used to be net revenue retention. It used to be all the regulars, LTV to CAC ratio, et cetera. But really right now, the first and most important metric that I've seen, at least in the market, is revenue per employee. How much does it take as far as human capital to produce what it is that you have?
And so obviously, I guess the more you can produce with less, the better. But is there a benchmark then, that a target that people are after?
It's not necessarily a ratio, but what I would say is that revenue per employee should actually be higher than your average ticket size. And I say that because it's very different. I mean, depending on the listeners of this show at the moment, it depends if your average ACV coming out of a 1-year contract is 20K, 30K. That's very different than if it's 100K or 200K. But as far as a benchmark, it needs to be higher than your average ticket size. That would be a very good rule of thumb.
Hey listeners, loving corporate CPR? Make sure you never miss an episode by subscribing on your favorite platform. Stay up to date with all our latest insights, expert interviews, and actionable advice. Subscribing is quick and easy. Just hit that subscribe button now and you'll be notified as soon as new episodes are released.
And what about, I guess you mentioned as well, are you gaining it sounded like you were referring to customer retention. So what are the relationships between that and ARR? Does ARR help retain customers, and lock them in, or what are you seeing in that space?
So ARR, in my view, is a measure of how much you can acquire customers. What you can do to retain customers is some deeper product level metrics. So time to value, how soon customers actually realize their perceived value in the product, how sticky is it? These things on the commercial side are also measured in your net revenue retention as well. So this is basically a view of your churn. So if you're gaining clients right away, but you're churning them out on the other end, that's not a great story. But if you keep gaining more cohorts of new clients and you retain your current ones, and you're also not just retaining them, but you're increasing the amount of products and services that they're buying, that becomes a very positive story.
Do you have any thoughts then, because obviously we've talked about, like, there's value to ARR and like, especially in economic downturn, to be able to have some stable revenue when maybe your transactional sales are not where they should be. So do you have any thoughts around companies and who are in industries where there's not usually recurring revenue, how they might approach the concept of ARR?
If there's not recurring revenue, or let's say it's once a year, so a good example of this would be like a tax filing, type of product where it's a once a year product. The way to do this is to keep clients engaged. It's a difficult thing to do. Try to keep clients engaged and try to turn your service into more of a data mining service instead of a transactional service. Transactional services can be a little bit more risky unless it's taxes. Taxes is different because it's compulsory. But if it is transactional, then clients view it as transactional. It's kind of set and forget, or it's once and done. So try to figure out a way to get clients to come back. Usually data mining happens to be a good way to do that.
Well, do you see, I guess, future trends within, the space of ARR and recurring revenue models?
I think right now it's not a future trend. I think right now a lot of the companies are trying to have what we're calling stable and repeatable sales. So, and this is more of the framework coming from the scale up community. But before, because it was hyper growth, grow at all costs. So you had these sky high ARR and revenue models, but then on the back end, everything was falling apart. Now investors are saying, okay, we want something that's stable and predictable. So maybe that growth trajectory doesn't have to be as high, but we want to know that you can repeat it every time. They want a sense of stability within the situation. So this is when you look at unit growth. So it's a little bit different. So even if you have your average ticket size is lower, if you can have repeatable unit growth, that actually holds more strength these days. So it's a little bit shaped by the market and the economic times that we're in.
Well, so how can companies ensure that they'll remain competitive, in this space then? Like, what are the things then they need to be shifting their focus to in order to meet the expectations?
Companies really need to be focused on building fantastic product experiences. In an economic downturn, and when you need stable, repeatable, predictable sales, very solid product experiences are the thing that really propel companies forward. The more stickiness you have to your product, and you asked me a question before about, customer retention, that time to value KPI. How soon after a client buys your product or service are they realizing their perceived or inherent value? The faster that is, and the more sticky your product is, of course, the more you're going to retain your client, but the more that you will snowball in the right direction and gain new ones. So that product experience and capability is extremely important.
So any, I guess, kind of practical tips on how a company could evaluate their current ARR offering and how to then improve it? Like ways to improve it and what they should be looking at? I mean, I know you've mentioned a few things along the way, but maybe there's kind of an approach.
I would say to look holistically, I would say take a cohort of the past couple of years, look at your ARR, if it's going up or down, look at the amount of clients that you have, look at the amount of products and services per client, start to build your story and your narrative. Even if your ARR is going down, but you're keeping more clients, or those current cohort of clients are buying more products and services later, I would say that that's a more positive story. So I would say really look at the nuts and bolts of what's happening in your business. It's much better to do that than to just put together a model of how you're going to continuously grow ARR, because that might not actually be the real problem. The real problem might be that you're churning clients out the back end, or the real problem might be that you have KPIs like LTV to CAC, or your customer acquisition costs are through the roof. So you would have to constantly gain multiples of new ARR to cover that core issue. So really start to take a look at what the core issues are. It's not just top line ARR is what I would say.
What about ideas around optimizing ARR? Are there like tools and resources people can use, or what are your thoughts?
There's tons. I'll speak as far as the sales, just bringing in more sales. One of the tools that I really love is a tool called Gong. So any kind of AI tool that, your sales team can use to listen in on the calls. Some of the AI features actually, talk about what the questions were, the inflection points, these are the issues the clients had. So there's, AI is changing the game. It's not the only tool out there, but it's a very popular one as far as the sales community is concerned.
Wow. Okay. So can you talk a little bit more about that? So it joins your like your Teams meeting or your Zoom meeting and analyzes the conversation?
Absolutely. It will analyze the conversation. It will, do the basics of recording how much you talk, how much your client talks. It will start to, it will basically take the written dictation of everything that is said. It will start to break things down, the different questions that they have, what's going on there. We'll start to do some basics of analysis and can really help sales teams push forward. So an example would be if a salesperson is doing a pitch and there's consistently particular questions coming up at a particular time, like it will start to bring out some of those just baseline insights and can help sales teams, reconstruct how they do the value proposition and which way they're doing the pitch, how you vary that pitch on the stakeholder on the other side who you're talking to. But a lot of these AI tools are becoming much more popular.
Wow, that's fascinating. I can see where there would be a lot of value. I mean, obviously sales is kind of in this space, but even a broader negotiation space, like how well are your conversations going in a negotiation? Interesting. Any other tools there? I mean, that's a fantastic
It's a fantastic
tip.
one. There's some tools out there. I don't have the name off the top of my head, but there are some tools out there that will even, write your prospecting emails for you. So I would just, start looking at all the AI tools, anything that it can be automated, look at how it can be automated so that your teams are left with the time to do the critical thinking pieces. So the SDR role, which is a very critical role, doing the outbound, the prospecting, a lot of these things can be automated. There are tools out there that will, scour the internet to help you find the contact information. So definitely in a sales motion, getting the person on the virtual line, it usually is very difficult. So, try to automate these things so that your team can really open up the time and space to use critical thinking and use their discernment on really, pitching your product itself.
No, that's great. And then I guess you mentioned for the sales team, are there other areas of ARR, and we don't necessarily have to go in depth, but along the process that really needs to be evaluating their strategies then and how to, advance ARR within their organization?
I would say that there's a huge debate right now amongst chief revenue officers and revenue leaders about how you actually scale. I would say the very traditional methodology was that you scaled with AEs and SDRs. So if you had to go from, 5 million to 50 million or 50 million to 100 million, a very traditional CRO would put together an Excel spreadsheet or, whichever model, and he or she would present to you, we need this many AEs and this many SDRs, and you would end up having a huge pit of AEs. So if you remember back in the 90s, that movie Boiler Room with Ben Affleck, and there's a huge pit of salespeople. That model has changed. Not all companies though, especially when they get to a certain size. So if you're at enterprise company or you're a Series D stage, if you're VC backed and above, usually you tend to see this model. What I'm an advocate for, depending on what your product and service is, and of course your average, contract value, is really kind of doing the digital way where your core set of AEs and SDRs are scaling the amount of units that you're selling and not having to scale the AEs and the SDR, because what does that do? It increases your overhead. And then that KPI that we spoke about before, your revenue versus your full-time employees, your revenue versus your headcount, it will, exacerbate that number as well. So when you're looking at that stable, predictable, repeatable sales, it's now about scaling units per salesperson and not just scaling salespeople.
Interesting. And then, have you seen instances, I suppose, where the value breaks down the line and what I guess one story I heard was around, the sales team did great, out there selling, and there was implementation, tied to this solution, and the implementation teams were falling down. So is there like a holistic approach to, I'm looking at my entire value chain and how I'm producing, this product or service, and how do I make sure that, we're going to be successful from start to finish?
This is where your solutions engineers really become important, especially if you have a more complex product offering that you're selling. So you really need everybody in the game at the beginning. So your solutions engineers usually are the bridge between your sales teams and your customer onboarding teams, and, sometimes your product and engineering teams as well. So I would say that's a key role and a key hire. Bringing everybody on board sooner. So sometimes really briefing your, whether you call them implementation, customer support, customer success, whoever at your company is doing, that onboarding implementation planning, making sure that they understand upfront what the client wants. And so this is the key breakdown that you're referring to, is you have the sales team on one side, the CS team on the other. Sales is selling, then they hand it off to the CS team, thank you and good night. And then the CS team picks it up and they're like, okay. And they really don't have a clue of what's happening because they weren't properly briefed and or they weren't, in the process at the beginning. So this is where having that cross-functional, sales leadership and cross-functional sales involvement is very important.
Do you see the mentality where maybe you have, maybe you don't have enough implementation people or whatever, the support people on the back end, but sales is kind of like, it's not my problem, and keep selling beyond, the capability of the organization?
It happens all the time. So, in small companies and big companies, it happens all the time. Salespeople are inherently driven by one thing, their incentives. So they want to sell deals and bring, the deals in. The best way to do this is to also make salespeople's commissions plans, really match the fact that clients are onboarded. And this is also where those KPIs that I spoke about before, like time to value, really become important. So people, salespeople or not, but people within an organization will do what they're incentivized to do. So if you're listening to this today and you happen to be a leader at a company and you have this particular issue, I would say, look at how people are incentivized and incentivize them differently.
Yeah, because you get what you're rewarded for, or the metrics, right? Yeah, people work to the number. Well, and then I guess, what are some of the key places where you see organizations fail when they're, in this ARR? We do talk about mortality events. Where do you see those mortality events come in to the picture?
I've seen scale-ups that scale up too quickly. I've seen large enterprise companies that have ruled a market for many years just sit on their hands and thinking that their current cohort of clients will continue to be there and really not be aware of the new and up and coming, products and services and ways of doing things. I've seen valuations go up and then tank, through the floor because people wanted to expand into different markets and they built up their organizations and then they have to scale back. Investors did an overvaluation and then they're, correcting the situation. I've seen, product which hasn't been there and hasn't scaled fast enough, along with the goals and the metrics of the business. So, that can be an issue. I have seen, incentives that were not holistic in the business, meaning that you have, culture dynamics within companies which cause different functions to infight with one another. And because of that, they're not focusing on progressing the business. So and then you have lost years of the business, and then the business, will have a mortality event. I've seen, startups not make decisions fast enough, and because of that, they run out of time. So there's all sorts of reasons, and you really just have to identify where you are at, and with your particular business, what you're good at, what you're not good at, and again, just look at things as holistically as you can.
Do you see issues? What do you see around, I guess, normally we don't talk about, well, I guess this could relate to larger companies. I was going to say, normally we don't talk to startups, but this could be impacting larger companies as well, where too much emotion gets involved and they get excited and you talked about overextending yourself. So do you see a lot of that emotional response to business, and any thoughts on how to control that and see reality and not just the ideal future?
Yeah, I've given a lot of talks about this before. I've kind of actually made a term for it. I call it white rabbit syndrome, where you're constantly chasing rabbits. So you have a CEO or founder, and this can happen at any stage of business. In enterprise businesses, especially if they're public, you have so many frameworks and due diligence, et cetera, and your stock price and your quarterly reviews to usually offset that, to prevent it. However, it can still happen. And a lot of times when you have these super visionary founders are wonderful and have changed the world in many ways. But on the flip side, they can chase a lot of white rabbits. And it really just depends. One of those white rabbits might turn out to be the golden goose, but a lot of them turn out to be frogs. So it really just depends. And I know it's very hard to gauge, but you really have to do your due diligence, the business case, what it costs to chase that rabbit versus what you believe you're going to get, and make the best business decision that you can. The danger zone comes in when a founder or a CEO is doing so much of this chasing that the company constantly is pivoting its objectives. If it constantly pivots its objectives, it never has the opportunity to see anything through the end or to execute anything. And this is the danger zone. And this is usually where you see the downward spiral occur.
What is your recommendation around maybe, yeah, sorry, I guess I kind of have an answer in my head that I'm asking the question to, but around, putting safeguards in around a visionary founder or CEO, like what are some of the things that can help balance that vision and entrepreneurialism that they might have?
Having a very strong executive team who's not afraid to push back, and also having the trust at the executive leadership level. So it kind of goes into a different topic, but especially in large enterprise companies, sometimes a visionary leader can make a dictation and that dictation stands. In other companies, a very visionary leader will throw out ideas and he or she will want to be challenged. And I definitely think the latter solution is the better one. But usually when you see things spiral, it's not for a lack of individuals that know that it's not correct. It's usually a lack of acceptance of the evaluation, meaning you have an executive team, they push back, they're not listened to. So, and this can happen in organizations big and small. But usually when you see something push through, somebody really wants it, they're not listening to the analysis or the tried and true best advice, the best practices. And this is where the danger can occur.
Excellent. Well, Angeli, this has been a great conversation. I'd love to hear what 3 things you want to leave top of mind with folks.
I would say know your client, look at your holistic ARR, your holistic revenue situation, and not just the top line numbers. And really be honest about where you are at your stage of growth. I think those 3 things will really make sure that you continue to grow and you have a stable and predictable revenue.
Great. And how can folks find out more about what you do or get in contact with you?
Sure. So the almighty LinkedIn. So everyone can look me up on LinkedIn. Very happy to connect and happy to chat with anyone.
Excellent. Well, thank you so much for being on the show, Angeli.
Thanks. Nice to be here.
Yeah. And to our audience, until next time, keep your organizations healthy.